Hello and welcome to Newscentre. I'm Parikshit Luthra. Foreign institutional investors have sold Indian equities worth $15 billion this year on a net basis. This pushed Dalal Street towards a prolonged sell-off period and a historic losing streak which took a breather only last Tuesday. The sell-off wiped out over $1.3 trillion of investor wealth. There is a growing clamour among market participants for a cut in long-term capital gains in order to make India attractive for global funds once again. Currently, foreign investors pay 10% tax on long-term gains. However, they would have to pay 12.5% tax from the 1st of April 2026 at par with local investors. Speaking at the ET Awards for Corporate Excellence over the weekend, Finance Minister Nirmala Sitharaman too weighed in on the issue.
As I said, there are some taxation matters on which, particularly the Parliament session being on course, budget session that is, there's only an intermission. The session is not sine die shut. And we are resuming on Monday, the most inappropriate time for a finance minister to talk on tax.
To take this forward, I'm now joined by Sunil Badala, Head of Tax at KPMG India, and also Akhilesh Ranjan, Advisor Tax Policy, PwC in India. He also is a former member of the CBDT. Gentlemen, thank you very much for joining us. Mr. Ranjan, let me begin by asking you, is there now a fit case to review the capital gains structure for foreign investors?
I don't really think so. I think a major overhaul was done in last year's budget in July. We have now a much simplified capital gains regime. You see, whether to tax long-term capital gains or not is a policy choice which countries make on the basis of their own economic circumstances. There are arguments which are against the tax, would say that you're taxing inflation, so how can you do that, or that you're preventing the switching of assets, so the markets are not building up momentum. But equally, there are very good reasons for taxing long-term capital gains. Because all gains are not inflationary. There is a substantial quantum of a proportion of the gains which are real gains, which come from valuations, from perceptions, particularly in the stock market. And it's also a point that if there's a zero tax regime for long-term capital gains or anything, it does shift capital away from productive sectors. So there are arguments for and against. I think the country looks at its own economic circumstances. I think India has examined this aspect very, very, very deeply, very well, and has a concessional rate of tax. Now, whether the increase from 10 to 12.5, as you say, is something which is driving away people, I don't think that's really the case. There are several factors, I think, which are playing in the stock market apart from the tax point.
All right. Sunil, to get you in at this stage, we have seen a major FII sell-off in 2025 alone. Many say this is only a temporary blip, but at the same time, several investors are saying that India will not be an attractive destination for foreign investors if we continue having the long-term capital gains tax. What is your thought? There is also a school of thought which believes that India needs long-term growth capital and therefore we need to make the tax structure more friendly for foreign investors.
So Parikshit, I think as Mr. Ranjan said, I think there are arguments both ways. I personally believe that there are a number of reasons why FPIs have pulled out the money. So yes, there may be a need for us to look at whether we want to make it more attractive for them by, removing or reducing the long-term capital gains tax rate. Now, I can argue that, look, until 2018, the long-term capital gains were exempt completely. Okay, and when the government introduced the STT way back in 2004, the whole idea was that they would exempt long-term capital gains, and obviously the short-term capital gains tax will be, taxed at a concessional rate, which of course has now changed. So since 2018, long-term capital gains, have been subject to tax at 10%, and now it has become 12.5%. So there are arguments both in favor as well as against. The argument in favor is that, look, long-term capital gains tax were exempt earlier until 2018. whereas the arguments to retain long-term capital gains is to say that, look, since 2018, it is subject to tax at 10%. So therefore, definitely, this is not the reason why FPIs have pulled down their money from the country. That
Right.
said, I
Now,
personally feel if not complete exemption, I think there is a case for some reduction in the rate of tax, because what has happened in the last budget, we increased the rate of tax from 10% to 12.5% for long-term capital gains, and for short term, we increased the rate from 15 to 20%, which is really steep, especially when you add up the education cess and the surcharge in.
right. So what could be the reduction in both long-term and short-term capital gains, according to you? Because it's not just you, Sunil, but there are a number of investors and experts who have said very openly, including Samir Arora, who have said that scrap capital gains completely for foreign investors. And should it be only for foreign investors or for domestic investors also?
So look, doing it only for foreign investors may not be appropriate, because there is going to be that, there's going to be a discrimination against the domestic investors to that extent. So I'm not sure whether it is advisable to do it only for the foreign investors. But having said that, if let's say if you have to do it, then we should do it for all. And what should be the reduction? I think on an immediate basis, if you ask me, we can go back to the rates which were applicable before last year's budget, which is 10% for long term and 15% for short term. There can be I think there is a scope for further reduction. So maybe we can look at, let's say, 50% of what it is today. But again, this is a matter of policy, and I don't know what call government will take. But certainly, in my view, there is a case for reduction of the rate on both long term as well as short term.
All right. Mr. Ranjan, do you believe that somewhere the government can review or reduce the capital gain structure for both foreign and domestic investors while we keep it, but reduce it to make India a more attractive destination for investments as well?
Well, I think the rate that we have, despite the increase, let's say from 10 to 12.5, or 12.5 is still a concessional rate, a massively concessional rate, with a timeline of just 12 months for the asset to become a long-term asset. So I don't think it's a case of overtaxation anywhere. The 12.5 increase to 12.5 was done essentially as a measure of rationalizing, bringing in uniformity in the capital gain structure, and not with a view really to tax more. And as I said, I can think of several reasons of several things that one should be looked at to see why the FPIs are moving out or they're selling, and not just be obsessed with the idea of tax.
All right. Whenever the government takes such decisions, there is always a very widespread consultation process, Mr. Ranjan. What are some of the challenges before the government, and why do you believe it is difficult and unlikely for the government to revisit the capital gain structure?
So as I said earlier, Parikshit, now the policy choice is whether to tax long-term capital gains or not. That's the basic question, and countries have their own views on that. Now, this really depends on the nature of the economy, whether gains are largely inflationary in nature, or are they based on real appreciations in values. What we see is, we look at the stock market out here, there are studies which say that there is not much of a significant correlation between the tax rates and the movement of the stock indices. So it's not something that even from inflation and the movement in the stock indices. The markets in India are driven more by the valuations of businesses and by the perception of prospects of growth in the market. So in looking at India's circumstance, I don't think there's a very strong case for reviewing the capital gain structure. I mean, there's no way of bringing it down to zero. And then I think it doesn't really matter whether it's 12.5 or 10. It's not of significant difference.
Right. Sunil, returning to you at this stage, yes, we've seen the stock markets go through a correction right now. But how do we see this from a long-term lens? From a lens of India's long-term growth story, our aim is to have a developed nation, a high-income nation by 2047. And for that, we need sustained growth of 7.8% on a year-on-year basis, as the World Bank has said, and investment to also significantly increase as part of the GDP. So if we have those long-term growth goals in mind, how does a correction or a reduction in capital gains actually help us in the long term, and not to go by the current sentiment and the stock market situation that we see right now?
So again, I think going back to the point I think Mr. Ranjan was also making, is that, see, depends on what we believe, right? And if the government's belief is that the current sentiment is because of various other things, like, weak performance of the rupee, this whole US bond yield being increased, and sell India, buy China kind of approach which foreign investors are taking, and so on and so forth. So if that is the reason, then I think we don't have to tweak anything. But I personally believe that if there is a reduction, you are actually making it more attractive for the foreign investors. And by the way, there are countries, including some developed countries, which do not tax capital gains in the hands of the foreign investors, especially FPIs. So yes, there is a rationale for us to kind of relook at how we are, taxing them. And if not complete exemptions, as I said again, maybe some kind of a reduction is something that we may consider.
Right. So, for example, countries like UAE do not have any capital gains. US offers a friendly regime. Countries such as Sweden have a very high rate of capital gains. But the argument there is the countries have a very strong social security net. If you lose your job, there is a very strong social net that protects you. But if you were to take the example of any emerging economy or developing economy, is there a precedent that India can follow?
So for example, and again, I'm just limiting my comments only to the long-term, capital gains, or just to the capital gains. So China does not tax, capital gains on listed securities. Malaysia does not tax. I think even US and UK, I believe, do not tax, foreign investors on the capital gains. So yes, there are precedents where the long-term capital gains on listed securities are not subject to tax in the hands of the foreign investors.
All right, Sunil Badala, Mr. Ranjan, thank you so much for joining us on the program. There is a big debate, of course, going on. The finance minister was also asked this question at the ET Awards, but she said that Parliament is in progress right now, and it would be wrong to comment on any tax-related matter while the Parliament is in progress. So she did not confirm anything. She did not deny anything either. Let's see what happens in the days to come. Time for a short break, but coming up, India and US are discussing ways to reduce tariffs, say Indian government sources. A special discussion with former Foreign Secretary Kapil Sibal when we return.